Picture this. One day, a single stock pays you $6,837 in 1 month. Not from $1 million account, from just $10,000. That number is real. I'm going to show you exactly where it comes from, but I'm also going to be honest with you right now in a way most channels won't. Here's the part most people miss. That $6,837 a month is not what you'd earn today. Today, $10,000 in that same stock pays about $25 a month. I know, that's a big gap, but that gap is not a trick. That gap is the whole point of this video. By the end, you'll understand 5 well-known dividend stocks. All 5 are sitting at or near their lowest price in a year. You'll know why each one dropped, you'll know what each one pays you, and you'll see how a small amount today can grow into real monthly income over time. And the part most people get wrong is this: 4 of these 5 are real bargains right now, but one of them isn't really at its low at all. I'll tell you which one, because I won't sell you a number that isn't true. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Here's how smart income investors think. When a great company goes on sale, they don't panic. They look closer, because a 52-week low on a strong dividend payer is often a gift. Let me show you the first one. It's already paying people every single month. The 8% monthly paycheck nobody wants right now. First up is Main Street Capital. The ticker is MAIN. Right now, it trades around $52. Its lowest price this year was $48.95, so it's sitting just above the bottom. Now, why would anyone ignore a stock that pays you every single month? Let me explain what Main Street actually does. It lends money to small American businesses. Then it collects the interest. That interest is what funds your dividend. Here's why the price dropped. The Federal Reserve has been cutting interest rates. When rates fall, a lender like Main Street earns a little less on its loans, so the income can dip. But notice what that is. That's a rate problem. It is not a broken business problem. The loans are still healthy. Only about 1.2% of them have stopped paying. That's a very clean book. Now here's what I love about this one. Since it went public back in 2007, Main Street has never once cut its monthly dividend. Not in the 2008 crash, not during COVID, not now. In fact, last month, the board raised the monthly dividend again by 1.9%. All in, the yield sits near 8%. That is the highest income on this whole list. And here's the part most people never see. Main Street doesn't just lend money. Sometimes it buys a piece of the business too. Back in 2006, it put a small amount into one Texas company. This January, it finally sold that stake. It collected a $17.3 million gain, plus $25.1 million in dividends along the way. That worked out to 62.7 times their money from one investment. So what does this mean for you today? Put $10,000 into Main Street right now. You'd collect about $67 a month. Real money paid to you right away every month. But here's the twist. The highest yield on this list is not where the biggest paycheck comes from down the road. The next stock yields barely 1%, and over time, it leaves Main Street in the dust. Let me show you how that's even possible.
The 1% stock that out-earns the 8% stock. Stock number 2 is Sherwin-Williams. The ticker is SHW. Yes, the paint company. Right now, it trades around $317. Its low this year was about $290, so it too is sitting near the bottom. Now, I need you to brace yourself because this sounds backwards. Sherwin-Williams pays a dividend of just 1%. 1%. Next to Main Street's 8%, that looks tiny. So why is it on a list about income? Stay with me. This is the most important idea in the whole video. Here's the magic. Sherwin-Williams has raised its dividend for 47 years in a row, not once skipped, and it grows that dividend by about 13% every single year. A 1% dividend that grows 13% a year becomes something very different in 10 or 20 years. Why is it cheap right now? Same reason as the home stores. When people stop moving, they stop painting. So paint sales slowed. But the business itself is strong. Last quarter, sales still rose almost 7%. And get this, their profit margin actually went up. They also just finished buying back $16.5 billion of their own stock. That's a company betting on itself. So here's the real lesson. Main Street is income now. Sherwin-Williams is income later. One pays you today, one grows your pay for tomorrow. Smart income investors want both kinds working together. Today, $10,000 in Sherwin-Williams pays only about $8 a month. Tiny, but that's not why you'd own it. You'd own it for what those rising dividends become later. So how does a 1% stock ever beat an 8% stock? There's one quiet force doing all the heavy lifting, and once you see it, every number in this video will finally click. The snowball. How $10,000 becomes a paycheck. Let's talk about that force. It's called reinvesting, and it's the engine behind every big number you'll see today. Here's the myth. You need a fortune today to earn real monthly income. Here's the truth. You need 3 simple things: a little money, some patience, and reinvested dividends. Let me show you how it works in plain English. You own a stock. It pays you a dividend. Instead of spending it, you use it to buy a little more of that same stock. Now you own more shares, so the next dividend is bigger, and that one buys even more shares. Round and round it goes. People call it the snowball. And here's the beautiful part. When a stock is cheap, like these 5 are right now, your reinvested dividends buy more shares, cheaper shares, more of them. So buying during a dip actually speeds the snowball up. The low price is working for you, not against you. Now, one honest word. These are projections, not promises. No one can guarantee what a stock will do. Dividends can change. So picture a careful version and a hopeful version, and let the truth land somewhere in between. That's how a smart, prepared investor thinks. A 52-week low isn't a warning sign. It's a sale on every paycheck that stock will ever pay you. Before I show you the next 3, do me a quick favor. Drop a comment right now and tell me one thing. Are you investing for income you need now, or income you're building for 10 or 20 years from now? There's no wrong answer, but it changes which of these stocks I'd lean toward, and I read every single comment. Okay, next up is the strange one. The only stock here that's already bouncing back, and it's sitting on a mountain of cash that most investors have no idea about.
The cash-rich rebel most investors are scared of. Stock number 3 is NetEase. The ticker is NTES. It's a big Chinese internet and gaming company. And right here, I'm going to be straight with you. NetEase is not really at a 52-week low. Its lowest price this year was about $106. Today, it trades around $124, so it has already started climbing back. I'm telling you that on purpose. This is the recovery story of the group, not a fresh bargain. I'd rather you trust me than sell you a headline. So why include it? Because of what's hiding on its balance sheet. NetEase is sitting on $24.3 billion in cash after all its debt. That's about 1/3 of the entire company, just in cash. Its games are booming too. Last quarter, gaming revenue grew 7%. The company earned $1.5 billion in a single quarter. Now, some folks saw its dividend drop last quarter and panicked. It paid less than the quarter before. But here's the truth. That's not a cut. NetEase pays a slice of each quarter's profit, so the dividend moves up and down by design. When profit is high, you get more. It's built that way. Here's the one risk I want you to know. NetEase is a Chinese company that trades here through a special legal structure. That adds a kind of risk most American stocks don't carry. So this is the higher reward, higher risk name on the list. I'd rather you know that going in. Today, $10,000 here pays around $20 a month, but that number moves with profits. Now let's come back home, back to American soil, to a dividend king that got hit by the worst housing market a 40-year veteran says he's ever seen, and it raised its dividend anyway. The dividend king they left for dead. Stock number 4 is Lowe's. The ticker is LOW, the home improvement giant. Today, it trades around $221. Its low this year was about $203, so once again, near the bottom. Lowe's CEO is Marvin Ellison. On the last earnings call, he said something that stuck with me. He called this the most difficult housing market he's seen since the financial crisis. Think about that. And yet, Lowe's just raised its dividend again. Here's why it hurts more for Lowe's. About 60 to 65% of its sales come from do-it-yourself customers, regular homeowners. And when people don't move, they don't take on big projects. So Lowe's feels the slowdown harder than most. But look closer, like a smart investor would. Last quarter, sales actually rose more than 10%. Online sales jumped over 15%. And Lowe's just bought 2 companies that opened the door to new home construction. That's a market it earned almost nothing from before. So even in a hard year, it's planting seeds. Now, the dividend. Lowe's has raised it for more than 60 years straight. That makes it a dividend king. This year, they raised the payment again to $5 a share. They didn't shrink in a tough market, they grew. That's exactly the kind of company a prepared investor wants. Today, $10,000 in Lowe's pays about $19 a month, and it has a 60-year habit of raising that pay every year. Which brings us to the stock on your thumbnail, the big one. It made a choice last year that tells you everything. It stopped buying its own stock just so it could keep paying you. Let me show you why that matters so much. The $6,837 machine. And here it is, stock number 5, Home Depot. The ticker is HD, the stock behind that $6,837 number. Today it trades around $312. This year it dropped below $290. That's a 2-year low. Same reason as Lowe's. The housing market is frozen. Fewer people are moving, so fewer big projects get started. But the business is not broken. Last quarter, sales still grew almost 5%. This is a giant that's simply on sale. Now here's the part that gives me real confidence. Home Depot has paid a dividend for 156 quarters in a row. That's 39 straight years. But watch what they did last year. They had a choice: buy back their own stock or keep paying their shareholders. They chose you. They spent $9.2 billion on dividends and $0 on buybacks. They paused buybacks just to protect that dividend. That is about the strongest signal a company can send. So let's talk about that $6,837 a month. Where does it come from? It's a 30-year picture. You put in $10,000, you reinvest every dividend, you let the snowball roll for 3 decades. In the hopeful version, that grows into a large balance, paying thousands of dollars a month. But I'll be straight with you. Home Depot's dividend growth has slowed lately. So picture a careful version that's smaller and a hopeful version that's bigger. The real answer lives in between. And today, that same $10,000 pays about $25 a month. The $6,837 isn't today, it's the runway. And the runway is the whole story. So, 4 real bargains, 1 rebound, 5 quality dividend payers on sale. The big question is, what do you actually do with all that? Here's the one idea to take with you. Let's bring it together. You just met 2 kinds of income. Income now, like Main Street paying you every month today, and income later, like Sherwin-Williams growing its pay for the years ahead. Put them side by side, reinvest the dividends, give it time. That's how a small amount today turns into a real paycheck tomorrow. And remember the one thing that ties it all together. When a great company goes on sale, the smart, prepared investor doesn't run, they look closer. A 52-week low isn't a warning sign, it's a sale on every paycheck that stock will ever pay you. If someone you know is sitting in cash, scared to buy, send them this video right now. It could change how they see a down market. And tell me in the comments, out of these 5, which one are you most interested in? Main Street, Sherwin-Williams, NetEase, Lowe's, or Home Depot? I really want to know. If you're building retirement income and want to stay ahead of moves like these, subscribe to this channel. I cover everything that helps protect and grow your income. And next time, I'll show you the monthly paying dividend stocks I'd buy if I needed income in the next 12 months, not in 30 years. You won't want to miss it.